All right, so pinning is a very important concept, and this is what pinning involves. Let's see. So now Apple on Friday, and we're going to come back, we're going to look at a chart, but Apple was pinned at $700, okay? And we're going to talk about why in a second. But what that means is that, you know, and if this is a $700 level, what's going to happen is then if the stock gets away from that, then sellers are going to come in and push it back, all right? And then if it gets below that level, buyers are going to come in and push it back. And it gets literally pinned at that $700 level with pressure this way and pressure this way, meaning that the institutions won't let it get too far away from the $700 level, okay? And the reason for this has to do with the open interest, and really the open interest, and you can see here like oh wow, October. So, and the open interest a lot of times is heavier and bigger on the monthly options, okay, than it is on the weekly options. So that's a weekly option right there, and you can see that $700 strike right now has an open interest of 7,000. But on the monthly level, it's got an open interest of 32,000. Okay, that's a huge number. Just looking at this, then what I'm seeing right now is actually a pretty decent probability, unless there's like a market crash, is that the October monthly pin, which is the third Friday in October, right? There's actually, even right now, a high probability that we could pin at $700 because there is so much open interest at that strike price. And let me get the, and if you look at this, and you can just kind of do the math here on it, but if you do, you know, it's like, well, how does, you know, why just 32,000? Well, if you do 32,435 times 100, okay, that represents 3.2 million shares of stock. Okay, that's actually, you know, that's a healthy amount of stock. And then you can look at, let me bring up another platform here real quick. You can see how to access my TradeStation account now. I call this my no freeze window. So let's look at Apple here. And well, first of all, just looking at this chart, look how it pinned, because the stock market was doing, you know, its own thing. So here's $700, right? And if we come over here and we look at $700, you're going to see a fairly amazing thing over the last couple of days. And that is a stock that came up to $700, okay, got pushed down, came up, got pushed down, came up, trade, got pushed down, came up, goes through it, comes back down, and actually has a big day, comes back below, gets pushed back up, comes down, gets pushed back up, gaps up, runs away, and then comes right back down into expiration. Okay, that's pinning right there. That's when you have such a huge, you know, open interest that it gets sucked back to that level. All right, you're thinking like, well, gosh, isn't Apple like this huge stock? How can it be manipulated like that? How can it be controlled? Well, oops, I didn't want to insert a strategy. Insert volume. And, you know, if you look on a day like this, so normally, on a normal day, Apple trades about, oops, you know, it'll trade about, you know, 14, let's call it like 12 million shares, okay, on a normal day, if it closes, it trades about 12 million shares, well, that open interest at 700 was 3.5 million shares, okay? So like 1/3 of that volume. So there's a huge incentive to pin the stock at $700 because all 3.5 million shares are on the line, and if they can close it at $700, okay, then guess what? Those options that they sold can expire worthless. And what can happen here is that these institutions, maybe the stock's at 650 and they go ahead and sell the $700 calls, right? And so then if it gets above $700, they're like, oh my God, I don't want that to happen. Let's push it back down so we can at least make money on these options, right? Have you ever had an option that you buy and it goes to zero? Guess what? An institution sold that to you. And they probably, if you held on to it to expiration, hoping to make some money on it, most likely it went exactly to zero because the institutions were manipulating. Exactly. I mean, yeah, the institutions sold these calls and they manipulate the stock so that they can benefit from that. Okay. Is it fair? No. But if you know about it, you can get on the same side as the institutions. Okay, and that's what makes it great. And that's what makes it fun. Apple's a fairly classic one. Another one here that we did on Friday was Amazon. And Amazon, we were looking at pinning at 260 and ended up selling the 260, 265 call credit spread. Remember, in that situation, oh, thank God, a latte. And in that situation, and again, most of the time on these pins, we're actually doing more of credit spreads, okay? The butterflies will come up when there's a huge open interest. But you can see here, Amazon's another one. And by the way, the only stocks that really pin are these large NASDAQ stocks, okay? The New York stocks do not pin because they're hard to manipulate. The NASDAQ stocks are easier to manipulate. And it's, the Amazons, the Baidus. Baidu used to be a great one. But you can see here, Amazon essentially just kind of hovered around the 260 level. And then if we look at Baidu, Baidu still has a lot of open interest. It looks like it pinned fairly close to the 110 level. Google doesn't have a lot of open interest, but it gets manipulated a lot, and Google's just on a tear. And by the way, we're going to talk about some Google plays here because guess what? If you look at Google on a monthly chart, Google's about to break out to new all-time highs. And so the question now is what kind of plays can we do? Let me get rid of this. To take advantage of that. And you can see that the monthly squeeze has fired off on Google, so you guys know what that means, right? There's no point fighting it. And you also know that on something like this, like a big move would be a move to its 1272 extension, which would take us to $878, okay? And it looks like it's going to do this regardless of what the stock market does. So this becomes, Google's a fantastic stock for selling premium because the premiums are so out of whack that it's hard to buy Google premium. It's hard to buy the options, but you can sell them all day long. Okay, all right. So that's a good question. Do you close out the butterfly or let it expire? You actually want to close it out. You can let the some of the legs, like if you look back here on my Thinkorswim platform, and what I still have credit for my account is, you can see I'm long the 705 call and long the 695 put. I just let those expire worthless. But if you're short, you can get assigned, so you want to be careful with that. All right, so let's come back here now and let's look at Amazon. So what you're looking for, yes, is high open interest, and you want open interest that's especially at a strike that really stands out. Now again, at the weekly options, the pinning isn't as powerful as it is at the monthly options, okay? And if you look here at the 260 strike for next week on Amazon, there's an open interest of 840, but if you look on the monthly, there's open interest of 3,000. So the monthly pins are the strongest in my opinion. However, there are, I have seen some things that happen on a weekly basis as well, which we do this in the live trading room, all day long on Thursday and Friday, is taking a look at these. Let's look at a couple more and see if there's any that are going to be setting up for next week. Goldman Sachs is one that's usually kind of fun, but you can see, again, on the weekly option, there isn't a ton of open interest. You know, like at the 110 strike, there's 12 contracts, but the 110 strike on the monthly has 10,000 contracts. And then again, you guys know that that represents a little over 1 million shares of stock, okay? And then you can also then go back and look at the volume on Goldman's, okay, on a daily chart, and see, you know, does that represent a decent, now this is, you can see this is a lot of selling on this day, but on a normal day, you know, Goldman's will trade about 4 million shares, so 1 million shares, that represents 25% of its outstanding daily volume. So that's what you're looking for, is if you find not only a high open interest, but it's a high enough open interest that it actually has a percentage impact on the outstanding daily volume that trades, that can actually have a pretty decent effect. Okay? Do you look at open interest calls only? No, I actually look at both. So you add up both strikes. Yeah, now, so Goldman Sachs is NYSE in general. I do not like the NYSE stocks for pinning. Goldman Sachs is the one exception. Why? Because the stock is manipulated all the time by Goldman Sachs. So most New York Stock Exchange stocks cannot be manipulated that easily except Goldman Sachs. And I think these guys, they run it for themselves all day long. All right. So here, I'll put together a little cheat sheet for you guys on this. All right, so we don't need that. Well, actually, we'll just do a new Word document. So let's document this. So this is one of the things I like to do just based on all the questions that I see. So we're going to make some notes here. Okay, so this is going to talk about open interest. And here's the notes. Open interest and pinning. So first thing you're going to do is you're going to look at both. Here, let me, I'll make this bigger. So this is a document that you guys will have at the end of this, okay? So you're going to look at, wow, I don't know what that is. That's an interesting tool. Oh, it must be for the Bamboo, okay. So you're going to look at open interest for both calls and puts and add them up. You are looking for the strike price with the highest open interest that is near within 2 strikes of the current price action. Okay, so what I mean by that is if, you know, if Apple's at 700 and there's 3 days to expiration, and the highest open interest is at the $500 strike, it's not going to go to $500. You know, you want to look for something that's within 2 to 3 strikes, and it'll typically get attracted to that. Okay, and then bonus, if total open interest represents 20% of daily volume or greater, then you have an even better chance of pinning. Okay, and so what is pinning? Pinning is institutions manipulating a stock to close at a specific strike price so they can collect 100% of the premiums that they sold on that strike. Example, Apple is at $690 and institutions sell the $700 calls naked. Apple goes to 705 like it did on Friday, and these institutions manipulate the stock back to $700 so that the calls they wrote will expire worthless. Okay, does that all make sense? I'm going to save this as we go through today, and I'm making notes and things like this. I will, you know, we'll make this available to you guys. Now, if you understand this, so strategies. Okay, let's talk strategies. So butterflies are good. Okay, if Apple at 695, okay, then, and you're looking for a move to 700, then you can do, you know, you could say, do a put credit spread. So put credit spread, sell 695 puts, buy 690 puts, and that way if it pins at 700, get max profit. Or you could also do, you know, buy let's see, 695 call and sell 700 call, debit spread for pin to 700. Okay, so really all you're doing is that, you know, once you understand these strategies, if you're looking for the stock to go to 700, you can start doing strategies around it. So the other final thing about this is that I've found that pinning works best on monthly option expiration, but works good enough on weekly. Okay, so what does that mean? That means generally for weekly expirations, I'm going to stick to put credit spreads. I'm not going to do butterflies, okay? Because the credit spreads, remember on the credit spreads, they're very forgiving. You don't have to be dead right to make money. On the butterfly, you actually need to be right. Okay, so overall strategy is credit spreads on weekly options expiration, and then adding debit spreads and butterflies for monthly expiration. Okay, so that's the overall strategy with pinning. Generally, on the weekly options, you don't see as strong of a pin, so what we do is focus on the credit spreads because they are better than that. Yep. So butterflies actually have to be mostly right. So that's why I wait to do butterflies for the monthly expiration. Correct. Yeah, and you can still make money on the butterflies if you're not dead right, which is very true. Okay. All right. So here's a couple of things for you guys then, because we're going to spend a lot of time in the room looking at weekly options expiration. So where's my paint? There we go. Okay, so let's talk a little bit about the weekly options. I'm going to review this real quick. This is something I've reviewed before, but it is critical to understand. And I'm going to do this. Let's do green. Okay, so this is the life cycle of a weekly option. Okay, weekly option starts trading on a Thursday, Friday. Okay, then we have the weekend. Then we go Monday. Okay, Tuesday. I'm not sure what color to make Tuesday yet. Well, I know what color to make I'm going to make okay, so I'm going to do this. I'll explain why in a second. All right, so does anybody know why I did the colors that way? Okay, here's the weekend, and I'm going to do this. I'm going to draw a line right there. Okay, so yeah, you guys, a lot of you guys have it. So here's the thing. Everybody thinks, you know, here's the weekend, you know, this is Saturday, Sunday. And a lot of people think that there's, you know, a lot of premium decay over the weekend. Okay, and so the question, you know, yes, no, is that exciting? So what happens is one thing that people do is they'll start selling premium on Thursday and Friday with the idea of buying it back on Monday, okay? And because they think that, wow, I'm going to get so much theta decay over the weekend, right? Because that's what happens. The premium expires a little bit each and every day. Well, you got to remember, especially in options trading, the person taking the opposite side of your trade is typically a market maker, and market makers do not take the opposite side of trades where they're going to lose money, okay, or where it's obvious they're going to lose money. So if this trade was so obvious, the market makers wouldn't take the other side of your trade, okay, but obviously you can do this. So what happens? So the implied volatility, what they do is on Thursday, when all these people start selling all these options, the market makers take the implied volatility, okay, which is used to price the option, and let's say it's at 30, and they'll knock it down to whatever they think it's going to be on. They mark it down to Tuesday, okay, which would maybe be like, let's call it 26. And what they do is they actually knock the premium off the options on Thursday and Friday to where they're going to be on Tuesday. So they're essentially taking the other side of these trades on Thursday because they know they're buying it at Tuesday's prices. So the only way to make money on, if you're selling credit spreads on Thursday and Friday and holding them over the weekend, the only way you're going to make money is to be right directionally, okay? If you were selling them, like say on Wednesday, you could be wrong and still make money, okay? On Thursday, Friday, you have to be right to make money. And so a lot of people don't know this because they'll do the strategy and sometimes they'll make money, and it's because, yeah, directionally they were right. So if they sold, say, a put credit spread on Apple, and Apple gapped up on Monday, yeah, they made money. And so they think, oh, wow, man, I love holding it over the weekend. Well, the thing was, the 100% of the gain that they made was because of the change in price of the stock. It had nothing to do, or very little to do, with theta decay. Okay, and the market makers actually hedge everything up. All they're doing is collecting theta decay. They don't care about the direction. As traders, we're more caring about the direction. So if you're selling premium on Thursday and Friday on a weekly expiration, you actually are completely losing an edge because you have to be directionally right to make money. Okay, does that make sense? You remember when we talked about those 5 fingers? The stock could go higher, sort of higher, sideways, lower, or really lower. You want to set this up so you've got a 4 out of 5 chance of being right. If you're doing this trade, you have to be like directionally right, okay? And that's not the point of selling premium. You might as well just buy a call or buy a put in this case. So this is a big red flag, and you got to be aware of it. So if you're aware of it, that's half the battle. Now, so what do you do with this, okay? Well, I actually like to do directional plays. And what I will do is focus on, if there's some directional plays that I like, I will buy options, directional options, on Thursday and Friday. You know, sometimes it's buying them on Thursday, selling them on Friday, okay? That's a great time to do this because you're getting very, very little theta decay. You're actually getting the same premium on Thursday and Friday that you're getting on Tuesday. So doing directional trades on Thursday and Friday with weekly options is fantastic. And when I mean Thursday and Friday, I mean Thursday and Friday of the new weekly options. Don't do Thursday and Friday when they're about to expire, okay? So you can buy here. If you feel up for it, you can actually even hold over the weekend and sell it on Monday, okay? But you got to remember that's a pure directional play. Like you like Apple, it looks like it's doing great. This is a cheap way to do it, okay? I love doing this trade. In fact, my biggest trade of the year was buying Apple on a Friday and holding it over the weekend, and it gapped up, and we got to collect all that cash. Now Tuesday I've got it green and red because that's the transition day. This is the day where you can actually start selling premium, okay? I generally, though, like to wait until Wednesday. So every week, what I like to do then is we're going to focus on, we do this in the live trading room, is, and by the way, just so you guys are clear, and what's going to happen is, and remember, the next week options will start trading right now too, okay? So this is So next week options. Okay, so there's going to be a time when you actually have the Thursday and Friday where you've got one set of options expiring, okay, and these are the ones that you sell, and then you've got next week's options, and these are the ones that you buy, okay. Those are the ones that you do directional trades in. And this is a beautiful concept, and we do this every week in the live trading room where Wednesday, Thursday, Friday, what we're focused on, you remember, okay, let's do this again, a stock can do essentially 5 things, right? So on Thursday, Friday, we're focusing on specific chart setups where directionally we think we're going to be right, okay? But once you get into Wednesday, Thursday, Friday, then you start focusing on trades where you can be right if it does these four things and wrong if it just does the one thing, okay? And I love doing this. So you could just make a living trading Apple, okay? Thursday, Friday, you focus on directional trades. Wednesday, Thursday, Friday, you focus on selling premium. And holding positions overnight Thursday to Friday, okay, on where it expires on Friday, you get a 33% theta decay overnight. That's your biggest bang for the buck right there. That's where you get the big decay. Everybody always thinks that, oh, I get the decay over the weekend, right? No, 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 no. You get it right here Thursday to Friday. Wednesday to Thursday is actually also pretty good, okay? Not as high as Thursdays to Friday, but it's still pretty darn good. Okay? All right, so if I bring up TOS, I'm using TOS, but you can do this on TradeStation or whatever. And let's look at, let me make sure. Now sometimes with the monthlies, they'll have things kind of screwed up a little bit, but let's look at Apple. Okay, so what's happening here is that the monthly is just expired, right? So what you're going to see here is on Apple is you're going to see this, okay? So on Monday, Tuesday, Wednesday, you're just going to see these weekly options and then next month, okay? Then starting on Thursday morning, you're going to see a new row, and that's going to be for the next weeklies, okay? Now, a lot of times, I mean, now to me, there's some things that are confusing here. It says September 4, 12, 6. Okay, what does all that mean? And it's actually very simple. Let me just bring up my calendar real quick. You guys can see all my appointments and everything. Okay, so well, let's look at the calendar here real quick. And first of all, where are we in September? Okay, this is the first week of September, second week of September, third week of September, and this will be the fourth week of September, okay? So we're heading into the fourth week of September, right? So then if you come over here and you look at this option, then guess what? 4th week of September. So that's what that means. And then what you're going to see is on Thursday, you're going to see, it'll probably say October 1, meaning the first week of October is what I'm assuming, or it may say September 5, depending on how they label it. But, so that's what that means. And this, of course, means that if they expire in 6 days, and then 12 is the year, 2012. Okay, so the big thing here is just looking at, that number tells you which week it is. So if you see, you're going to see 2. If you see one that's September 3 and then one that's, September 4, then this is going to be the 3rd week of September. That was last week. This will be 4, and then you'll know this is the current week, and that's next week. Okay? Okay. Yeah, and you can look at the calendar and everything like that too. So, all right, so you guys understand pinning. What I want to do now is we're going to start transitioning. So the two main things I want you to understand is just the basic setups of some of the spreads. I want you to understand pinning, and I want you to understand on the weekly options when you're buying and when you're selling. Overall, do you guys have a good feeling of that? Okay, great. I'm seeing yeses across the board. If you're still a little rusty on it, that's fine. Guess what? This is being recorded. I'm going to send you these presentations and stuff like that. But it's key that you understand those 3 things before we can actually move on to the next level. This is like walking up a flight of stairs, okay? You've got to, or it's like learning math. You got to learn, a squared plus b squared equals c squared before you can do, square root of that. I don't know if that makes any sense or not, but we're just going to go with that. So the next piece of this, and I'm going to talk a little bit about implied volatility, and I've talked about this before, but this is a critical piece. And this is the last piece before we get into the charts. But you'll notice when you look at, you're going to look over here and say we bring up Apple options, and you're going to notice the most important number on this chart is right here. And this is the implied volatility of generally the options, okay? And you can see that the implied volatility is pretty similar for the weekly option versus October. And by the way, are there any earnings next week? Does anybody know if there's any earnings coming out next week? You can see for December, it looks like it's 30%, and I think, there may be, that's the next time that earnings come out for Apple, so you can see the implied volatility is already brushing up. Okay, so Nike. So let's look at Nike real quick. Okay, beautiful. This is exactly what I was looking for. Now, what do you guys notice on the Nike options? What is the first thing that stands out? Okay, perfect. So for those of you that don't know, this right here is the number we're all looking at, okay? Implied volatility on the options that expire next week is 52%. Next week, it's 34%, okay? That is huge, okay? And if you guys can understand, now some of you guys already understand this, I totally get that, but there's some on here that have no clue what we're talking about. I'm going to teach you this in the next 4 minutes, okay? But this right here is going to make you more money trading options than anything else that I will be able to show you, is this differential right here, okay? So good question. How do you know normal IV? Normal IV is typically in all the months following, okay? So, and this is a good comparison because what may happen is you may go and look at some stocks, okay, and that number, okay, and let me clarify this, okay, good question. 52% in and of itself is meaningless, okay? That means nothing. What I'm interested in is how this volatility compares with this volatility, okay? That's what we're talking about here. Okay, you guys get that? I don't care what the numbers are. The value is irrelevant. All I care about is what does number 1 look like compared to number 2. Okay? Yeah, and there's a lot of different things you could do with this, and so I'm going to try to keep this as kind of simple as possible. What we're looking at here then is the relationship between what's going on now, okay, which is this line, versus what's normal, which is the rest of this. Okay? Now, the reason this is bumping up is because there is an event coming up. Okay? And an event in many cases is earnings. And what happens with earnings create uncertainty, okay? And with uncertainty, what happens is that the premium on the options increases. You guys get that? And that kind of makes sense, right? Here's the key takeaway, okay? Once we remove the uncertainty, what's going to happen to that implied volatility? Okay? Once we remove, so uncertainty drove the volatility up to 52%. Okay? Once the uncertainty is removed, guess what? The volatility is going back to about 34%. Okay? 34%, give or take. 34, 29, somewhere in there. And this, I want to emphasize more than anything else, is a dead-on certainty. Okay? With dead-on certainty, we know that once earnings are over, implied volatility is going to go from 52% back to the neighborhood of 34%, or maybe even 29%. But we know it's going to drop back to those levels. That is absolutely 100% guaranteed certain. There is, in fact, no other certainty in trading than that. Okay, that's the most certain thing that you're ever going to get in trading. If you can get your arms wrapped around that, I want you to think about that for just a minute, because if you can get your arms wrapped around that, you will have just made a huge leap as a trader. I know some of you in here already get it, okay, but when this hit me and I realized this, it really changed my outlook on trading. Okay, this is called, you'll also hear this as implied volatility crush. Implied volatility collapse, okay? And what you're doing then is that you're looking for a way that if this event is a certainty, if it's certain that we're going to go from 52% to 34% in implied volatility, and that's a certainty, then the question is, of course, is how do I make money from that certainty? All right, you guys get that? Because if you got, and I know some of you guys already get this, but for those of you that have not really thought about this before, this is going to be kind of a new thing. If you can get this, it's going to change your trading. All right? All right. Now, let's look. Are there any other earnings coming up? I saw Nike, and this isn't, we're not in the middle of earnings season right now, so, gosh, what's another one that's coming up? RHT. All right, so RHT has earnings, but now if you, okay, Red Hat. So now look at this. You've got 49% implied volatility here, and then normal volatility is between about 41%. All right, now we do have a certainty that we're going to go from 49% to 41%, right? But the question then is, can we make money on that small drop? And the answer is, it's kind of slim pickings. Like, that's actually not worth the risk. And in fact, it's even showing you what the expected market maker move is 44 cents, which we'll talk about that in a second if you're not sure how that works. Okay? So let's look at a couple of other ones that are coming up. Yeah, let's look at MOS. Okay, nothing there. Monsanto, nothing there. And we're looking for stuff that's next week. Nothing there. So again, so far right now, Nike's kind of the one. Now, let me show you if I can find this real quick. I mean, to me, this is the most exciting part of options, and that's why I want you guys to really get this. And I know some of you, and believe me, I know some of you guys do. We exchange ideas and stuff like that. Gosh, is this it? Let me see if I got a couple of snapshots here. Okay, So here, let me show you this real quick because this gets a lot more fun when we get. So what we do in the live trading room is this is kind of our core thing. Is when we get back in the 4 times a year when we get in that hot and heavy earnings season, we're doing this every day almost. And from current slide, okay, this is an example of F5. This is what we want to look for. Okay. What you generally want to look for is IV is 2 times normal. Okay. Anything over that, okay, if it's over that, equals huge bonus, okay? Now, and by 2 times normal, I mean if it's normally at 20, then we want to see it at 40, okay? If it's normally at 40, we want to see it at 80. Now, Nike doesn't quite fit this, but that's okay. This is ideal, right? Because, again, what's the certainty here? The certainty here is on F5 is after the earnings are out, it's going to go back to 44%. Okay? This is screaming out you loud and clear that the implied volatility is going to collapse from 116% back to 44%. JBL. We'll look at JBL then, too. Okay? Now, we'll talk more about the trades and stuff like that, but so that's what you can do. So what's going to happen here is this, okay? And do you guys know how implied volatility affects the price of a stock? Okay, and this is where the ill-famed spreadsheet comes into play, because I want to show you guys this. I don't know why I said ill-famed. It's actually a pretty damn good spreadsheet. Now, I've got 2 spreadsheets here. I've got one that I made. It looks like this, and then I've actually had a couple of you guys actually kind of update it and tweak it out, and they actually look better. But so what happens on something like this, okay, is, you know, let's take this right now. So you can sit there and say, like, okay, God, I really want to make sure I slow down on this because I know some of you guys already get this. I don't want to rush too fast on this. So hold on. So before we get in on this, I want this to be an aha moment. Let me see if I've got Green Mountain Coffee Roasters on this too. I can't remember if I took screenshots of Green Mountain. All right, we'll go back to this. Yeah, and we will. So at the end of this, guys, I'm going to give you guys will have links to the PowerPoints, the word notes, and the Excel spreadsheets. I want you guys to know all that. Okay. Now, we're getting ready to make a transition here, guys. We're going to cover a little more basic stuff on implied volatility, and then we're going to go balls to the wall. Okay. So I want you guys, for those of you that are newer and don't fully understand implied volatility, I just want you to understand it. Okay. And the main thing to understand on implied volatility is this, and I'm just going to keep this very simple, is that implied volatility does impact the price of a stock, okay? And in fact, let me see, and I hate the definitions of the Greeks. Like, if you go look up implied volatility and, you know, all that stuff, to me, it's always confusing the way they do it. So I'm just going to do this very simply. And I wrote down some notes on here, blah, blah, blah. That's good. Yeah, and I've covered that Iron Condor PowerPoint before, so I will actually go through it again today. We'll kind of, I wasn't planning on it, but you know, I'll cover what I want to cover, and then we'll just kind of do that as a little extra. All right, I'm just I'm going through my notes real quick here because I've got this fairly decent example of implied volatility. Okay, there, gamma. So a lot of times you're going to hear about, you know, delta, gamma, you know, all that kind of stuff. And I actually don't think it's that important to understand it. I mean, you need to understand, but it's not as critical as you think, unless you're really just trading pure math. And we don't. We trade off of chart setups too. But in general, what you want to know is that if implied volatility, okay, let's say it's 100%, okay, and it's like before earnings, and it's normally 50%, right? Then what's going to happen is, okay, and let's say Apple is at $700, okay, and the $700 call at 100% volatility may be $10, okay? Well, if the implied volatility drops 50%, then the option price also gets cut here too, okay? And in fact, it'll collapse. You know, in this case, I mean, it's, you know, give or take, but the premium portion of the option gets annihilated, and that's what implied volatility is. And what happens is that there are times with earnings is that after earnings, the implied volatility immediately collapses, and it immediately crushes the premium portion of the option, like destroys it. And this is why what gets really, really fun is, like, one of my favorite plays that we did this year was on Green Mountain Coffee Roasters, because the implied volatility before earnings was like 300%, and it's normally like 50%. So it was going to get annihilated there, and selling premium on that was, I mean, it was like taking candy from a baby. So when you see something that's that far out, and what happens with that is, like, so Green Mountain Coffee Roasters, you know, the prior earnings, they got dumped, and then everybody's thinking like, oh my God, it's going to be this crazy thing, and that drives up the price of the implied volatility. Okay? Yeah, and to be clear, so implied volatility is just impacting the price of the option. So what I'm saying here is that if implied volatility is 100% and the $700 call is $10, if implied volatility drops to 50%, the price of the option at the money option is also going to drop. Okay? So implied volatility does impact the price of the stock. And you've got to bring in like these deltas and gammas and stuff like that. But I just know that if implied volatility drops, then the premium portion of the option also drops. And I think we don't need to get any more complicated than that, okay? Does that make sense? And again, I know some of you guys understand all the Greeks and stuff like that, but I don't want to go into the Greeks here because it's not, you don't need to know those. I just want you guys to get the idea that if you've got an event where implied volatility is going to get crushed, then you have a guarantee, okay? You have a guarantee that implied volatility is going to go back to normal after that event. Now, you don't have a guarantee that you're going to make money on that trade, but you can. What's nice about this, okay, and this is the last little step here before we jump into advanced stuff, okay? So here's the setup. You've got 100% implied volatility pre-earnings, okay? And you know that normal is 50%. So you know it's going to go back to 50% post-earnings. Okay? So do we all agree that that is a certainty? If it's 100% pre-earnings and it's normally 50%, then after earnings we're going back to 50%. That's, I mean, there's very few things out there that are 100% certain, but let's call that 99.999% certain. Okay? And what's going to happen is that those at-the-money options will immediately get crushed. All right. So now the question is, how do we make money from that knowledge? Okay? And this is where we take this to the next level. Because what happens now is that market makers, in fact, you know what, let me, okay, we're going to do this. Market makers price in uncertainty on a standard deviation basis. Okay? And that standard deviation, so standard deviation plus implied volatility equals price movement. All right, so what do I mean by that? Okay, and this is where the spreadsheet comes in handy. And let's, how can I do this here? View. There we go. All right, so what I'm going to do, I'm going to take a real example here. Well, let's just do this. So stock's at 100. Stock's at 100. All right, and the implied volatility. So we've got a $100 stock price. Okay, this is all just as an example here. And let's say the implied volatility is 100%. Okay. Now, what I want you guys to watch is I want you to watch this. Okay. So we're going to say the implied volatility is also 100%. All right. Now watch this right here. Enter. Okay. So now what it's telling us is that if you have a $100 stock with 100% implied volatility, then the expected max price movement for essentially one standard deviation is $6.25. Okay? I don't know why it says 0%. Let me check something real quick. In fact, let's just actually take a real example. In fact, let's go back here and take the Nike. So we're going to say Nike is at $96.52, right? And the implied volatility is 52.05%. So Nike is at 96.52, right? Implied volatility is 52.05%, okay? And what that is telling us is that the market makers are pricing in a one-day price movement of $3.14, okay? That essentially there's a 48% chance that it's going to make a move that is confined $3.14 one way or the other. All right, so this is actually not, not that sexy, but now if the implied volatility drops back to 34%, then that $3.14 move drops back down to 2. Okay, so we just went from an expected move of $3.14 to $2.07, and when there's a higher expected move like that, guess what? The premium on the options goes up. When there's a lower expected move, the premium on the options goes down. And that's why, the premium drops. Now, what gets fun on this, and where this gets very, very fascinating, is that you can actually use what I call, use these standard deviations to price in how much of a chance of success you want on it. So let's go back over here, 52.05% chance. And how this works on a standard deviation basis, okay, now that's the pure implied volatility price, but how that works on a standard deviation basis is one standard deviation is $2.63, okay, and then a 2 standard deviation move is $5.26. Now what this means is that it has a 68% chance of exceeding a 1 standard deviation move, okay, sorry. Let me clarify this. There's a 68% chance that we're going to stay contained within a 1 standard deviation move, and a 94% chance that we're going to stay contained within a 2 standard deviation move. Okay, this knowledge is, okay, it's kind of cool, make those some sunglasses. This is knowledge is power to its finest, right there. Okay. Yeah, so I've got it actually a more advanced spreadsheet here. In fact, let me tweak this up a little bit here. So again,